Welcome to The Explainer. Today we're cutting straight through the noise to unpack the stark reality of Ethereum's current landscape. We're going to discover what's actually happening right beneath those chaotic price charts we've all been staring at.
So, let's dive right into this massive paradox. Is Ethereum heading for a massive 5x breakout, or are we staring down a 20% crash? Now, I know Ethereum's recent price action has been, well, incredibly frustrating for a lot of you. But here's the crazy part. While the price chops around, the underlying on-chain fundamentals are quietly hitting absolute record highs. Seriously, they're off the charts.
To objectively unpack this wild duality, we're going to break it down into 4 parts. First, a tale of 2 markets. Second, the institutional bull case. Third, the retail and macro bear. And finally, the specific signals to watch in 2026. Let's get into it.
All right, part 1, a tale of 2 markets, the great disconnect.
Industry experts like Nick Puckrin are pointing out something fascinating. We're watching a historic transition where 2 entirely different crypto markets are literally existing at the exact same time. On one side, you've got the institutional era. These guys are patient, they're low risk, and they're treating Ethereum as a disciplined reserve asset. But then, you flip to the other side, and it's total retail apathy. This group is highly speculative, impatient, and constantly getting crushed by short-term volatility. The big takeaway for us here: while everyday retail investors are pulling back out of pure frustration, massive institutions are quietly stepping in and forming the market's new core foundation.
Which brings us right to part 2, the institutional bull case, building the backbone.
You see, recent U.S. regulatory clarity has essentially handed Ethereum the ultimate institutional stamp of approval. And this newfound foundation has led analysts to outline this massive 5-5-5 supercycle framework. Their bold prediction? They're saying Ethereum could surge 5 times from its base, taking it to an astonishing $15,000 per token. Yeah, 15K.
Let's look at the actual data driving that massive claim. Projections show tokenized real-world assets jumping from $18 billion to $100 billion by the end of 2026. That's a 5x jump. Stablecoins, they are similarly projected to absolutely explode from $300 billion to $1.5 trillion. So think about it. If both of these massive financial sectors multiply by 5 and the vast majority of them live right on Ethereum, the math suggests the network's underlying value simply has to aggressively reprice to match that massive growth.
And the smart money knows this. Major Wall Street players and institutional treasury companies are quietly accumulating ETH right now. In fact, we are seeing 4 distinct MicroStrategy equivalents actively building up Ethereum treasuries. This means they are buying and they are holding for the long term. It strongly echoes that huge corporate adoption wave we all saw with Bitcoin back in 2020.
But how exactly are these giants actually interacting with the network? Well, it's through a trend called Build Your Own Blockchain, or BOB. Instead of using those fast but highly centralized competitor networks, financial titans like JP Morgan and Robinhood are launching their own custom Layer 2 networks directly on top of Ethereum. They get their own dedicated space, but it's fully backed by Ethereum's unmatched decentralized security.
The dominance here is just staggering. Over 60% of all stablecoins and an astounding 90% of tokenized real-world assets currently operate on Ethereum. By prioritizing absolute uptime, security, and neutrality over short-term revenue hype, Ethereum has overwhelmingly become the absolute best place for global financial institutions to do business, hands down.
All right, let's flip the coin. Part 3, the retail and macro bear, battling headwinds.
Look, I know staring at Ethereum's lagging price chart lately can make you want to pull your hair out. So we really need to pull back the curtain on the severe downside risks that are currently dominating the retail side. We're tracking 5 distinct macro and technical headwinds right now. On a global scale, you've got geopolitical tensions like US-Iran friction, spiking oil prices, and inflation fears that are tightening everyone's wallets. Domestically, the charts just look heavy. We're seeing dense technical resistance at $2,340, big wallets risking a cost basis breakdown near the 2,228 mark, an exchange supply ratio divergence, and totally weak demand in the derivatives market with negative funding rates. When you combine all these factors, it paints a sobering reality. Ethereum genuinely risks a 20% pullback toward that $1,730 support zone.
But, and this is a big but, the market right now is like a tightly coiled spring. There is currently $8 billion, yes, billion with a B, in short positions piled up against Ethereum. Why does this matter to you? It's simple.
If the price actually manages to break through that technical resistance, despite all those macro headwinds, it could force all those short sellers to frantically cover their positions, and that would trigger an absolutely massive wave of forced buying.
And honestly, this perfectly explains why 70 to 89% of retail traders lose money. It's a three-step trap. Step 1, internal liquidity engines see your clustered stop losses. Step 2, the exchange's algorithm targets sudden price wicks to hit those exact levels and liquidate you. Step 3, the user interface triggers these dopamine addiction loops just to keep you trading. You have to realize, you aren't just battling the market, you are trading inside an engineered liquidity trap designed to extract your capital. It's literally like a digital casino.
So, where do we go from here? Part 4. Signals to watch in 2026, the verdict. Because our sources are painting such a heavily divided picture between massive institutional building and struggling retail traders, this framework is going to give you a data-driven roadmap to navigate the year objectively. For a true bull market scenario, we need to see liquidity ease up and adoption accelerate, which would be validated by a rising ETH/BTC ratio and strong ETF inflows. A base market? That means mixed macro conditions but steady, reliable network usage, basically range-bound prices. And a bear market requires tight liquidity directly colliding with falling demand. Basically, a true bear market only happens if tightening macro conditions ruin those otherwise strong on-chain fundamentals.
So, to keep you grounded, here is your ultimate monthly signals dashboard. Instead of gambling on daily price wicks and driving yourself crazy, use this exact cheat sheet. Track the ETH/BTC ratio and Bitcoin dominance. Watch those institutional ETF net flows. Keep an eye on stablecoin supply expansion, Layer 2 activity and fees, and finally, macro real yields. Monitor these closely. They will tell you whether Ethereum's massive institutional usage is finally overpowering that short-term retail apathy.
As we wrap up this explainer, I want to leave you with one final provocative thought. In this wild tale of two markets, which one are you trading in? It is absolutely crucial to reflect on whether your personal strategy aligns with the patient, calculating institutional builders or the reactive, highly leveraged retail traders. Think about that as you plan your next move. Thanks for hanging out and learning with me today, and definitely keep watching those signals.